Well, Happy New Year, everyone. This is Jim Curzan, and this is the Capital Market Review for fourth quarter 2024. Hope everybody had a great holiday season and a wonderful start to the new year. As we do every quarter, we come up with a song theme that best reflects the environment, the feelings currently of the market or the economy. And I couldn't help but think of the Beatles song "Here Comes the Sun." Certainly after the election and the kind of a little bit of a market spike that we had since then. The title or the lyrics, "The smiling faces" or "the smiles are returning to their faces," somewhat reflects this hope that Trump is going to solve some of the problems that he campaigned on. That said, some of that euphoria has since faded, and as we'll see in a few minutes, the stock market is looking at things differently than, let's say, the bond market, which is clearly worried about a few things as well. We do these quarterly reviews in an attempt to answer where we are and where we're heading. We want to get two things right: where we are in the economic cycle and what the Fed is planning on doing. Clearly, we kind of know what the Fed is doing now. They are beginning to loosen in terms of tightening, which has been the case the last couple of years. We have now seen 3 cuts to a total of 1%. Our agenda is relatively short, although we do have a lot of data to share. We'll spend some time on the economy, specifically the macro data, much of what we've discussed before. And then we'll also talk about markets from a valuation point of view. Are we in some kind of a bubble, or is everything simply unicorns and rainbows? As I mentioned a number of times, the data will ultimately lead to one of two things. We will either see that the data shows continued weakness until we somewhat see a drop. That's generally how recessions happen. It's not so much a glide path. It's data looks really bad for a long time, market's euphoric until it isn't. And then things change very quickly. Or the data starts to improve and we see this soft landing scenario. In either case, we would have hoped to have seen some broadening out of the market where performance is coming from other areas outside of just the Magnificent Seven. I don't want to spoil the end of the report, but we really haven't seen a lot of this broadening out, which makes things that much more, let's call it, complicated. As far as some of the broad-based economic data, the leading economic index continues to fall. It ticked up for the first time in the November reading, which was reported out just after Christmas. And it was the first tick up we've had in many, many months, like 30 some months. But the trend, as you'll see, continues to be down. The yield curve, which had been inverted for a better part of 2 years, is now to a certain degree uninverted or normal. It's uptrending. The blue line that we see across the page represents the current yield. You'll see short-term rates 1 month are a bit lower than long-term rates 20-year. A year ago, which is the dark gray line beneath, you can certainly see an inversion where short-term rates were higher than long-term. That inversion has somewhat flattened out. Part of the flattening out is a function of the Fed cutting interest rates. So short-term rates have come down. But what also has happened, and is somewhat curious, is long-term rates have gone up. Since the Fed started cutting rates in September, the 20-year Treasury yield, the 10-year Treasury yield has risen. That's not what you'd expect. The bond market is telegraphing something entirely different. The problem with that is all financial product, mortgages, car loans, other consumer type debt are all pegged to the 10-year, not the 1 month Treasury. And as a result, those rates have been rising and mortgage rates have been rising. So while the Fed's cutting, long-term rates are going up. Not what you'd typically expect to see. The bond market is worried about something that the stock market is not. As far as the inversion and now the rewriting of that, that also tends to be a normal course of events. This is exactly what happens in every single recession we've had as a result of an inversion. The gray vertical lines represent the recessions we've had going back 50 years. The blue line represents the yield spread, or the difference between the 10-year rate and the 1-year rate. Normally, 10-year yields are higher than 1-year yields. So as a result, that spread would be positive. And anytime we see the blue line above the red 0 mark, that's a positive yield spread. And we can see it happens more often than not. The yield curve is ascending higher longer. Every once in a while, it drops and you'll see it break below the red line on occasion. That's an inversion. That's when short-term rates are now higher than long-term. And the recession comes thereafter in every single case, without exception, the last 50 some years. However, the recession doesn't happen at the time of inversion. It happens after interest rates flatten and then normalize. Then the recession comes. If we look at where we are today, far right-hand side of the graph, we'll see not only is the yield curve now positive, it's broken back above, but we'll notice two other things. One, that the inversion was the longest in history. It's longer than any of the others preceding a recession. I know things look a bit garbled around 1980 because there were actually 2 recessions back to back, but it's also the second deepest inversion we've had as well. Not a lot of data on that, but the little bit of data we have would suggest the longer and deeper the inversion, the longer and deeper the recession should it come. Looking at other data that kind of supports where we are in terms of the economy. I mentioned the LEI, the leading economic index, and the fact that it actually ticked up in November, first time in 30 some months. However, if we were to look at the 6 months split, what has happened to the yield curve the last 6 months and how that related to the prior 6 months, we'll notice that the LEI actually has fallen more recently than it had in the past. So this is at best somewhat cautionary, clearly a yellow sign. If we look at the third from the top, credit card delinquencies, we've heard for a long time that, boy, the consumer is rock solid. We're beginning to see credit card delinquencies, those that are now 90 days late or more, over 11% of all credit card balances. Effectively, 1 out of every 9 credit cards is now delinquent 90 days or more. That's up from where we were a year ago of 9.5%. Again, we've been suggesting data has been weak for quite some time. It was weak a year ago. It's weaker still. One thing that's coming on quickly are default rates and delinquency rates with commercial mortgage-backed securities or mortgages on office buildings. That delinquency rate through December, just reported this last week, is now over 11%. It's a new all-time high, surpassing even the financial crisis, which peaked at below 11%. We've been talking now for 2 years about the empty office buildings, and people are mandating return to work, but that's happening very slowly. There's also a concern that these mortgages that roll, as they are typically 5 years in length, will be rolling at much higher interest rates today than they did 5 years ago, when interest rates were nearly 0 and a 5-year mortgage was 3%. Now, commercial mortgages are more like 8 to 11. And the other issue is collateral. Back then, everybody worked in an office building. You had plenty of rental income, plenty of collateral for those mortgages. You don't today. So delinquency and default rates are rising. Just to give you an idea, 2 years ago, that default rate was 1.6%. It's now 11 today. And between now and the beginning of 2027, there's over $2 trillion worth of mortgages commercial mortgages, office-based mortgages that are expected to roll. Many might not even come to conclusion because the owner of the buildings are required to bring more capital and they just simply don't have it because they don't have the rental income. So we'll see what this does, but those data points are not suggesting soft landing and things are beginning to improve. It's suggesting these long and variable lags that we've spoken about ad nauseum are beginning to start to bite. When we look at manufacturing, we've been in a recession, and that's probably one of the reasons that the market outside of the Mag 7 hasn't done particularly well. If you look at things like the Philly Manufacturing Survey, which represents business activity in the Atlantic Northeast, it declined to a minus 16.4 in December. It was forecasted to be a slight positive. So that's a huge drop. And then the month before, the difference between October to November was also nearly a 15% drop as well. Not a sign of improvement, but continued problem. And in Chicago, it's the same thing, consistent reduction in the forecasted number. The problem is all these are produced by Federal Reserve banks. Every Federal Reserve bank has a different legend that they deal with, so it's hard to compare one to the other. All you have to look at is kind of trend. And in those cases, they have been falling. Factory orders came in less than expected, a negative 0.4. That's at the wholesale level. That's also a bit of a problem. The thing that's been a bit wonky and really hard to wrap around is employment. If you want to make an argument that things aren't so bad, you can do that. If you want to make an argument that things are getting weaker, you can do that as well. These numbers have been prone to a bunch of revisions. The unemployment rate did tick up a bit in November. We'll see what happens in December. We do have some massive employment numbers that come out as recently as tomorrow. And then the PPI number, or the inflation number, that has actually been creeping up a bit. So the last 3 months, we've seen an increase in core CPI as well as PPI as well. So there's a number of things out there that just aren't indicative of problem solved. We're on to recovery. When we look at the components of GDP, one of the biggest components that we see here recently has been government spending. And we've seen that over the last, effectively, 2 years, a very large component. To put this in perspective, if you look at government spending, historically, it has represented about 0.2% of a 2.3% real GDP, or about an 8% component. Today, it's 0.9 of a 3% GDP, or something closer to 30% component. It's a significant increase, a fourfold increase in government spending during a time when, if the economy is strong, you don't spend, you knock down the deficit, you knock down national debt, you don't expand it. I mentioned that employment is kind of wonky, a bit difficult to get your hands on. There's generally a progression. You look at job openings, you look at quit rates, and those things tend to decay a bit earlier than layoffs. And as you can see from the JOLTS job opening, it's been generally downtrending. There'll be an occasional uptick, but it's certainly come down quite a bit from 12,000 2 years ago to just over 7,700 today. Not quite, but nearly cut in half. And the number of quits, those that voluntarily quit because they can get a job elsewhere, has dropped significantly as well. And those things are the things you see leading into and during recessions. Let's turn for a second to markets. And markets have been all over the place. December, the month that we just finished, was essentially a down month. The S&P was down almost 3%. The equally weighted S&P, which doesn't get a lot of juice from the Mag 7, was down well over 6. The Dow Jones was down 5. The NASDAQ was barely down at all. And the Russell, the small cap index, the one that is really reflective of economic strength in the US, was down over 8. Making it even more difficult, bonds were also down. The Barclays aggregate was down over 2. The US Treasury 20-year was down almost 7. And as a result, balanced accounts were down. You saw a big drop in portfolio value in the IRA, close of business December 31st versus November. November, the IRAs were up 7. A lot of that was given back in the month of December. For the quarter, it was a similar story. Many of the broad-based indices, international was down 10, emerging markets was down 9, Russell 2000 was flat, Dow Jones Industrial Average was essentially flat, yet the S&P was up 2 because the NASDAQ, which is Mag 7 heavy, was up nearly 5. And that's also reflective on year-to-date numbers. So as a result of that, you're getting an S&P whose valuations are getting really stretched. Right now, the S&P's PE ratio current is almost 30 times earnings. That's an extremely high number. Forward PE is 21.5, which is also a very high number, well over 1 standard deviation removed from long-term average. And when you dice and slice the S&P, which is a cap-weighted index, skewed because of the Mag 7 and big tech, you'll see that from a PE perspective, a cyclical adjusted PE, dividend yield, price to book, price to cash flow, just about every variation you want to look at is 1 to 2 standard deviations stretched from long-term average. And we can see from this chart, anytime we get somewhere above 1 standard deviation removed, at some point, there's a sizable pullback. And you look at peaks, 2000 was the last big bubble. We're not that far from it in terms of PE. Does history repeat? We don't know. But it's certainly something to consider because these valuations are getting somewhat hard to justify. Part of the reason for that is it's really skewed toward the big tech stocks because of this AI investment theme. Right now, the top 10 stocks in the S&P, by the way, 7 of them are technology-based, represent nearly 40% of the S&P. Back in 2000, during the last recognized big bubble, where valuations were extremely stretched, it was just a hair over 20%. And to give you more detail as to the Mag 7, I showed the December fourth quarter year numbers, and then I showed the weighting of those 7 stocks on the S&P. Microsoft representing 6.3%, Apple over 7.2%, NVIDIA nearly 7%, and so on. So the S&P for the quarter was down 2.7%. The S&P for the month of December was down 2.7%. The Mag 7 for the month of December was actually a positive 0.8%, or nearly up a full 1%. For the quarter, the S&P managed to be up 2%. The Mag 7 was up nearly 4% on a weighted basis, meaning they contributed 4% to the S&P. Since it's only 7 of 500 stocks, what does that say for the other 493? Well, we saw it. Most of the other indices were down. And for the year, the Mag 7 contributed 22% to the S&P's performance. The S&P's performance was only 24. So you draw your own conclusions. It's a bit stretched. And to think, hey, this party's going to continue, it may for a while, but when it ends pretty brutally. And that's the concern I have. If you're listening to this and you're still mid-career, plenty of time till retirement, don't worry about it. You're dollar cost averaging, you're accumulating wealth, and that wealth will transcend into greater wealth down the road and will shorten the amount of recovery time. But if you're retired and this is what you've got and you've got enough, you don't want to present a situation where you could see a big drop in value. And a lot of the data is pointing to that happening at some point. Is it worth it staying in the market, trying to catch another 5% when the downside risk can be quite significant? To put the bubble size in perspective, let's look at this. I took a look at the top 7 stocks currently. We'll call it Meg 7, although Berkshire Hathaway's in there as well. And I looked at the top 7 back in 2000, where arguably that was just before the crash of the dot-com bubble, when, by the way, the S&P dropped 52% in what was a very, very mild recession. And the NASDAQ dropped well over 80. And when we look at market cap today, those 7 represent 33%. I mentioned the 10 represent nearly 40. In 2000, as big a bubble as it was only 20%. Free cash flow on some of the Mag 7 are trading as high as 56 times cash flow. Nobody would enter into a business agreement paying 56 times cash flow. The average in 2000 was 16. Current PE, as I said, is about 30 compared to about 16. When you look at the 7 contributing to earnings, they contribute 24% of the S&P's earnings compared to, in the bubble, nearly 14%. Why that's important is nobody knows if and when we go into a recession, or if and when we have a correction. And I'm sure a lot of people back in 2000 felt the same way. You don't understand. It's different this time. This is all about the internet. This is a revolutionary technology, on and on and on. Here's a list of the top 10 today. Apple, Microsoft, Amazon, NVIDIA, Google, A and B. They take 2 placements. Tesla, Berkshire, Meta, United Health, and Exxon. And then the top 10 in 2000. Exxon, GE, Cisco, Pfizer, Walmart, Microsoft, Citigroup, Merck, AIG, and Intel. And since that was the bubble and nearly the top, I just went out 2 years and said, okay, where were they priced in 2002, 2 years removed, and what kind of a drop was that? Exxon was down 26%, Walmart was down about 30, and then the tech stocks, Intel was down 80, Cisco was down nearly 90, Microsoft was down 60. And it took years and years and years to recover from that. Now, the point I'll mention on this is, if you look at today, 7 of the top 10 are tech related, primarily because of AI. Back in 2000, during the height of the dot-com bubble, only 3 of the 10 were traditional technology stocks. There were others certainly throughout the marketplace. And that's important because when you're dealing with high PEs, as we are these days, 20, 25 forward-looking PE ratios, the forward-looking return assumptions over the course of a year and the course of 5 years is really, really low. Why? Because there's usually a sizable pullback or correction along the way. And you can see that by this dot analysis. One last thing about valuation, and that is simply that Warren Buffett also believes that the market is somewhat bubblicious. There's an index or an indice, a ratio that he uses that's not taught in business school, certainly not taught in finance. It's something he created that better helps him assess whether we're in a bubble or not. Those who follow this more closely may have read articles or seen reports that his cash level in Berkshire Hathaway is as high as it's ever been. He's been selling a lot of positions, raising somewhere between $250 to $500 billion sitting in cash. And he's done that only on rare occasion. He's the buy and hold long-term kind of guy. And he wanted to develop this ratio to better get clarity to himself on where things are. You see, when you're in a bubble, it's really hard to believe it. Everybody's making money, or you're feeling like you're missing out on making money, and things look great. And stock analysts just continue to increase earnings estimates. They have nothing to lose. Time is on their side. 7 out of 10 years, the market goes up. And if they're wrong and wrong big, nobody will remember it a year or two out, except those who suffered the consequences. And strategists will be quick to tell you, hey, it's different this time. You don't understand. It's not about earnings and cash flow. It's about the amount of time eyeballs stay on websites or some other craziness that we talk about in terms of valuations. So he wanted something that can cut through all that. And what he did is he said, all right, look, here's the ratio. We'll look at the total value of the US stock market, large, mid, small cap, every publicly traded stock. That's the numerator. And then the denominator is GDP. So 1 is the price and value that traders and investors are putting on publicly traded companies, which are supposed to reflect the total productive future nature of those companies. And the denominator is the sum total of goods and services produced and consumed within the United States. Now, it's not a true ratio because, as many of you know, publicly traded companies only contribute a fraction to GDP. Most of the growth is from small companies. My little company has 17 employees. We contribute to GDP, although it's not reflected in this number. To say nothing of huge, large corporations that are also private, not public. Think of all the partnerships that are out there, law firms, accounting firms, Cargill with 180,000 employees, not included in the number either. So the ratio he uses to determine excess. If the ratio is 50 to 70%, stock value is 70% of the GDP, the market is probably fairly valued. As it starts to move to 100%, it starts to become overvalued. And then it's a degree of overvaluedness. As of September 30th, the Buffett ratio hit an all-time high, 208%. And as of December 31st, it was 209. It might be a bit lower than that now. If we look long-term, looking at this backtesting to 1950, Buffett probably created it close to 1955 or so, I would imagine. You'll see anytime we've had these things stretched, the ratio has come down significantly. We're now well beyond 2 standard deviations removed from normal trend. The last time was in that cryptocurrency meme stock speculative sell-off that we had in 2021, and the market sold off about 30%. We also had a 2 standard deviation move in 2000, and the market sold off 50-some%. And the NASDAQ, which created a lot of that bubble, sold off well over 80. And we were also 2 standard deviations back in the late 60s, and there was that period of time from 60 to about 74 where the market sold from peak to trough well over 50 as well. These are ratios. So remember, if you go into a recession, GDP growth, the denominator, only loses a couple of percent. 2, 3, 4% is a fairly sizable decrease in GDP. So if the ratio is dropping this much, it's because the value of the total stock market is dropping that much more. And that's what we're concerned with. And one of the reasons we're remaining somewhat defensive. Growth, because of big tech, has well outperformed value. And you'll also see that during recessions, the gray bars, the chart starts to spike, meaning value stocks start to outperform. In many of our portfolios, we really don't have a lot of growth because of these valuation concerns. We do have value. The problem is value hasn't been recognized. The Dow was down 5% last month. And it is until it isn't. But these valuations are quite stretched. One other point of consideration is we're at a point today where the difference between the US market and the international market on a price to earnings or PE ratio is as high as we've ever seen. And at some point, there's typically a mean reversion. Doesn't happen often, but I can remember back in the mid 90s where for 5 years in a row, the international markets coming off of a similar situation outperformed the US by a factor of 2-1. Nobody knows the timing of this, but there are some real dislocations that at some point we should see some degree of mean reversion. So there you go. That's what things look like at the end of the year. We're plodding ahead. The market's off to a fairly weak start so far. Bonds are off. Value is off. The market is flattish. And we'll see what happens in the upcoming weeks and then what happens following the inauguration. If anybody has any questions about any of this, please reach out or shout to us via email. Once again, thank you very much for your trust and confidence. Have a wonderful, healthy, prosperous, and happy new year. Thank you.